So you're all aware that this is our last session, and I have announced in the last class that we will not do anything new in this session. So we will just repeat stuff, underline what's important, and I will talk about the exam. But I will first repeat, and then at the end I talk about the exam. So at the beginning, we have talked about compounding, and there are two very important concepts there. First, how do we compound at various intervals? How do we compound if we compound it every 6 months, every year, every month, every day, or even continuously on infinitesimally small amount of time? Then we talked also about the difference between the nominal and the effective interest rate. And we said effective tells you how much more you earn after 1 year. Annual effective interest rate is how much more you earn after 1 year. Now nominal, when somebody tells you nominal interest rate is 3%, do you know how much do you earn after 1 year? Well, it depends. It depends whether these people are at which interval of compounding these people are compounding. So when you go to a bank and when they tell you the rate is 3.5%, you know everything if the rate is expressed as the effective interest rate. But if it's nominal, you still need more information. What? How frequently this compounding? Because 3% with compounding at 1 month and in 6 months is a very different thing. And you should really understand this concept. This concept has caused a lot of confusion in the homework dealing with pricing of bonds. Because the rates and the yield curve were expressed as nominal with semi-annual compounding. You should be able to understand this concept. We have dealt with this in our first classes. You should understand very well the concept of the future value as well as the discount factor and the present value. This is what we have talked a lot about. And in the homework, I also can see that there are some confusions with some problems with the homework number 1, with the concept of the future value. This is the one with the problem with how much do you have to save for the school and stuff. There is a concept of future value embedded there, because I ask you how much money you will have at the end of 6 years, 5 years, I don't remember. But this is the future value concept, and you should think about it. You have the solution. So discount factor, present value. Now, when it comes to calculated present values, we said this is important because every firm should maximize the present value. And every firm should maximize the present value because people can borrow and lend money. You can borrow money. If there was no borrowing, then you would have to give to more impatient people money immediately, and to less impatient people, you can give them money less later. But the point is, since borrowing exists, the goal of every corporation is very simple: increase the net present value. And this is the first order effect. There are some other corporate goals. Some people will tell you corporate social responsibility, environmentally friendly, and stuff like that. Yes, I mean, this is also important. But if company is not increasing net present value, it will die. It won't exist. No matter whether it's dirty or clean, it won't exist. So this is the first order effect. The other things are also should be taken into account, but they are second order importance. Then we have talked about some very special cash flow streams, like perpetuity annuity, constant growth perpetuity, constant growth annuity. And with these cash flow streams, we have derived formulas how to calculate their present values and conditions under which these formulas work. Like, for example, constant growth perpetuity formula works if G is smaller than R. If G is larger than R, then this thing has an infinite present value. It's an infinite. Now, but we said one important thing, which is take care about the timing. These formulas work as they are here. Blindly applying this formula is okay if the first payment is in one period of time ahead of us, for example, 1 year. Now, what's the problem in every exam so far that I have given? That people mix this. They say, okay, if perpetuity, let's say, imagine you have a perpetuity that starts paying amount of C in year 11. And now people will say, the present value of this perpetuity is C over R. No, it's not. This is its value at year 10. Claiming that C over R is the present value of perpetuity that starts paying C at year 11 is C over R, as well as of the perpetuity that starts paying C amount of money C in year 1 from now are the same, would be exactly the same as saying, it would be the same mistake as saying $100 today is the same thing as $100 in 10 years from now. No, it's not. So take care about this. Timing is very important. The timing is very important. These formulas, as we have derived them, work if the first payment is 1 period in advance. If it's somewhere in distant future, you have to additionally discount them. You have an example if it's even closer to the future. In the homework, you have the example where you have a perpetuity that starts in that pays every year, but starts 6 months from now, starts half a year from now. You have this problem in the homework and you have the solution of this problem. You should be able to calculate these things as well. So take care about the timing. The timing is the most common mistake. You know, I don't ask you to learn these formulas by heart. You can have them with you at the exam. So you don't have to memorize them, though they are very easy to memorize. And if you do 10 exercises, you will know them by heart. I mean, you simply cannot not to remember things as easy as this. But take care about the understanding of what they mean. This is more important. I have given you in one of the classes this example of calculating the present value of some mixed cash flow stream, which you have some payments in some first period, second period, third period, fourth period, and they are all different. Sometimes annuities, sometimes growing perpetuities, sometimes you do them by hand, sometimes using the formulas. Every year I give an example like this. This year you will have an example like this as well for sure. So you will have an example of some combination of different cash flows. It won't be the same, obviously, otherwise it would be easy. You would just have it on your paper. It will be a different cash flow stream, but it will be some combination of the cash flow streams that we have learned. And you will be asked to calculate the present value of this cash flow stream. Why is this important? It's not important because, you know, I think this is important. This is what you do in everyday life in almost any firm in the world. You have these combinations of cash flow streams. And using the tools that we have learned in this class, you can calculate the present value of any cash flow stream whatsoever. There is no cash flow stream that you cannot calculate now, after this class, after just 10 sessions. You can calculate present value of any cash flow stream whatsoever. So you should be able to do that. To give you an example, I mean, this is not only a thing that finance people do. I have a friend who is an engineer. He works in some German company that is building these windmill farms. And you know, they have to decide, should we build this windmill farm and how much money will it produce over next 10 years? Is it worth it or not? Should we invest the money or not? And you know, these are complicated cash flow streams. You have expenses, you know how much it costs you to fix this windmill, how frequently they have to be fixed, how much do you have to invest to build them, how much are legal costs, how much is that? And you know, at the end, you end up with just constructing a cash flow stream like this. Is it worth it or not? Should we do it or not? This is what he does every day in his job. This is his job. And he's an engineer. He's not a finance guy. He's just creating cash flow streams and discounting. And they look very much like this one over here. You model them for first 20 years somehow and then say, okay, this thing will continue producing forever some amount or will grow at some amount or whatever. Now, bond pricing. This has caused quite a bit of confusion, I can see, from homeworks, from survey and stuff. Hopefully, solutions that you got with the homeworks will help you answer this question a bit more. I will talk now a little bit about it. So, these examples are not how it's done. This is how it's done. The point is that this yield curve, this data that you get from the US Treasury website, is expressed in nominal annual rates with semi-annual compounding. You should understand what it means. It means that each of these points tells you how much you earn per 6 months times 2. It's as simple as that. So it tells you that, for example, R1, if R1 is 2.5%, if you read this for 1 year maturity, 2.5%, that means that in reality you don't earn 2.5% per year. You earn half of it every 6 months. So per year you will earn 1 plus R1 divided by 2 to the power of 2. Okay? Any questions regarding this? Now, the most common mistakes that people have been doing in the homework regarding pricing of the bonds is the following. If you have a 4-year bond like this, people would say, okay, I will then use 4 years rate. I will figure out what is the 4 years rate. Some of them actually did it right. They divided it by 2, but they used R4 in every of these cash flows to discount every coupon. This is wrong. Why is it wrong? Well, think about the 4-year bond is nothing more but like the sum of these bonds. Imagine that you had these bonds. This would be exactly the same thing as if you had this bond. This is the same cash flow stream. If you own 4 bonds like these 4 at the bottom, 100 in a year from now, 100 in 2 years from now, 100 in 3 years from now, 1,100 in 4 years from now, this would be exactly the same as if you own this bond. So how would you calculate the price of this 1-year bond? You would use R1 rate to discount it. R1 divided by 2 and 1 plus R1 divided by 2 to the 2. That will be the discount factor, okay? Now, how would you discount the bond that matures in 2 years? Well, you would use the yield curve. Now, don't get confused by this. This is not that difficult. Just think about it. Get more self-confident with this. It's not that complicated. Just understand, when you read that these rates on the yield curve are actually nominal annual with semi-annual compounding, think about what that means. Nominal annual with semi-annual compounding. That means that actually the real rate that you earn for 1 year is not this nominal rate. It's actually 1 plus 6-month rate to the power of 2. Now, but pay attention also. Try to think about the yield curve in the following way. Yield curve is actually constructed from each point on this yield curve is a yield to maturity of a 0 coupon bond that matures in each of these different periods. So for 1 year maturity on a yield curve, this is the rate that you would get if you have invested in a 1 year 0 coupon bond. This is why in this example you are discounting what matures in 1 year with this rate, because this is the rate that 1 year bond gives you. This is why you are discounting a 2-year coupon with a 2 year 0 coupon rate, because this is what the 2 year 0 coupon bond gives you. So the yield curve actually is just these spot rates on yield curve are nothing else but 0 coupon bond yield to maturities of different maturities. So 0 coupon rate of 1 month bond, 6 month, 1 year, 5 year, 10 year, 20 year, 30 year. Okay? Any questions regarding this? Okay. Then we talked about the duration of the bonds. And we said this is very important concept. So pricing of the bonds is important for many obvious reasons. It's obvious. Why would you like to know what is the fair price of a bond? You want to know if you own a bond, how much is it worth? For which price I should sell this bond? For which price I can buy some bond, etc. There are many obvious reasons why would you like to know the price of a bond. Now, when it comes to the duration, we said this number is expressed in years. This is kind of the number that tells you this bond is as sensitive as some other bonds, zero coupon bonds of this maturity. And it's pretty easy to calculate, actually. It's pretty easy to calculate. You just calculate percentage of the total present value of each of the payments that this bond offers you, multiply it by the time period in which it appears, and you add these numbers together. And you don't have to know this by heart. Even though it's simple, if you do it once, you will know it, you will just remember it because it's simple. But now, why is it important? Because it tells us how much this bond is sensitive to movement in prices. How price is sensitive to movement in interest rates. So if you observe this slide, and you have this slide before, all the slides are the same. So the duration, if we divide it by 1 plus yield of this bond, by 1 plus yield to maturity of this bond, this will tell us how much the price of this bond will change in percents if you move the interest rates up and down for 0.5%. Now, in this example that I have given here, we are looking for the change in price. So the right-hand side of this slide tells you, okay, what is the present value of this bond at 5%, which is the current yield to maturity? What is the present value if the yield goes up 0.5 percentage point, and if it goes down 0.5 percentage point? And then you observe the change in price of 1.3% down when the interest rate goes up, and 1 plus 32% up when the interest rate goes down. But the same result you could have obtained by dividing the duration with the yield to 1 plus yield to maturity. Now, why is this important? If you remember the example from the exercise, I ask you, okay, calculate the duration of some bond, and then compare what you get by dividing this duration with 1 plus yield with the change of the price of a bond if actually whole yield curves is shifted up and down. Okay? You observe in the homework, there is one problem in which you shift the whole yield curve up and down. And you get approximately the same thing. And shifting whole yield curve up and down and calculating all the present value, it's time taking. But if you tell me the duration, I know approximately how much I will influence your value if I change it up and down for some number of percentage points. But think about it in the following way. If you were a government, what you do is you are moving actually yield curve up and down. If you read the newspapers, you can see all the time European Central Bank has lowered down the interest rate. European Central Bank has raised the interest rates and stuff like that. That means actually they have shifted up the yield curve up or down. That's the same thing. When they say we have lowered down the interest rates, means yield curve in parallel kind of move down for some number of percentage points. And why are they doing that? When they move the yield curve down, they stimulate people to invest more into economy because bonds are now on average offering less. Also, they are lowering, in a sense, because the interest rates that bank will charge you if you ask for a loan depend on the interest rates. So the higher the interest rates, the more the bank will charge you. The lower the interest rate, the less will bank the charge you. So for firms, it gets cheaper to borrow money. They can go to a bank and get better rates than if the central bank lowers the interest rates down. So this helps economic recovery in a sense. It helps industry to produce, to get cheaper money in a sense, and to get people investing more into economy. Now, but in the same time, governments sometimes also decide to push the interest rate down for various reasons, push the interest rates up for various reasons like inflation, etc., etc. But the point is that in this process, they don't want to kill the banks because banks are not supermarkets. They can kill supermarkets. You will go and shop in a different supermarket. You won't be sad. But if they kill banks, they destroy money that people are holding in these banks. Banks are financial intermediaries, and they may cause troubles to many firms and many people. And they don't want to do that, because then they will lose the elections. Now, in the classes, I told you actually how to reconstruct this yield curve. So what I was saying is, these spot trades, these points, are actually what yield to maturities of zero coupon bonds of different maturities. But after some period of time, after let's say 1 or 2 years, there are no more zero coupon bonds. You have only bonds with coupons. So how do you reconstruct the curve further? I showed you in the example. You first reconstruct for the first part when you have zero coupon bonds. You calculate yield to maturities of these zero coupon bonds. And then using these rates, you discount coupons of the higher maturity bonds. You discount their coupons first, and the rate of the last payment will be your higher maturity rate. But since I have seen that many people have got confused with this bootstrap according to questions, survey, whatever, I will not give this into exam. This is my mistake. I haven't explained it well enough. This won't be in the exam, but it's not that complicated. So this bootstrap, I will remove it because I have not explained it obviously well enough. Next year I will try harder. Now this slide has also caused some confusion to many of you, because I have used a different notation in this slide than I use usually. And this was on purpose to make you think about this slide. And some of you have thought and figured it out, some of you have not. So let me try to explain it once more. So what do I say? In this slide, I try to talk about the yield to maturity of a bond. And yield to maturity is a return of a bond that will make the present value of the bond equal to its market price. And market price is if you discount each of the coupons with the appropriate rate from the yield curve. But don't get confused with this R1, R2, R3, R4. First of all, note one thing. This bond has coupons every 6 months. These are 10% coupons paid semi-annually, which means you have 5% coupon of the face value every 6 months. This is what 10% coupon paid semi-annually means. This is how it's translated to the cash flow stream. Now, what's confusing for people was, you see, I'm discounting a 6-month bond with R1. That means that R1 in this example is not a 1-year rate. Okay? This is actually one half of the 6-month rate. So this R1 in our notation from the yield curve example would be actually R0.5 divided by 2. This R2, you see, this is something that matures in 1 year. This would not be R1 in our previous slides. This would be R1 divided by 2 and not R2 as I denoted here, okay? You understand what I'm trying to say? This R2, you see, this is a coupon that matures in 1 year. That should be a 1 year effective annual rate, okay? If it's expressed with a square, it should be 1 year effective 6-month rate. So for the bond, for the maturity on the yield curve of 1 year, you would read the value, and let's say you get 3%. Then you would divide this value by 2, and this would be R2 in this example. But this is just the notation. Don't get confused by the notation. I have honestly been so sorry that I actually intentionally did this, but I caused more confusion than clarification as I was expecting. Do you understand what I'm saying here? Any questions regarding this?
The third and fourth, the cash flow has to be R2, yeah?
The third and the fourth,
Yeah.
they have to be different. Yeah, so for the fourth one would be, in our notation from the previous slide, it would be R2 divided by 2. And the third one would be something in between, R1.5 divided by 2. You understand now? So in the notation from the previous slide, R4 becomes R2 divided by 2. Okay? Because R2 is the annual rate. The annual rate. But you know, on the yield curve, you read only the nominal annual rate. You don't read the effective annual rate. Nominal annual rate, when compounding semi-annually, means that after 6 months, you earn half of it. Okay?
R1 in this example is the rate you get after 6 months.
Yes.
And you divide it by 2?
I divide it by 2 because it's expressed as nominal annual on the real yield curve. When you read it from the real yield curve, even for the rate that is 6-month rate, it's expressed as a nominal annual. So you have to divide it by 2 to get a real 6-month rate.
Nominal semi-annual.
No, it's expressed as nominal annual, but with semi-annual compounding. This is how it's said. Nominal annual because this is kind of nominal per year. But nominal per year means nothing if you don't know the compounding frequency. Nominal annual.
Okay, but shouldn't you take it then to the square? Because you just get...
This one, yes. But look, this is a coupon in 6 months. The first coupon is in 6 months, so it should not be to the square. To the square, it should be only after 1 year, because this R, if we take this, if you say that this is R 0.5 divided by 2, this R1, okay? Then this is what you earn for 6 months, and this coupon is actually a 6-month coupon.
Okay, but you earn this in the 6 months 2 times, or?
No, you don't. Because nominal annual tells you that this is how much you earn in a sense. Nominal annual means nothing. Nominal annual means in 6 months you earn half of it. So if I tell you nominal annual rate is 3%, that means for 6 months you earn 1.5%. And this is the rate that you should use here because this is only 6-month thing. Okay? So you should understand also the forward rates. Forward rates are important because they are used a lot in real life, much more than you would expect. And you know, forward rates are something that you actually calculate from the rates on the yield curve. You see this R3, R2, this is what comes from the yield curve, from the term structure of interest rates, as it's said. So when I say term structure of interest rate, this is just a fancy term for the shape of the yield curve. Nothing more than that. So these R3, R2, they come from the yield curve. And by observing the yield curve, you can figure out actually the forward rates, which are rates that if you sign a contract today, you can get on a loan in the future. And this is used a lot. You don't have to be a finance professional to be in a need of using forward rates. Actually, these forward rates are used even much more in non-finance industry than in finance industry, because they are used to avoid having financial risks. And usually non-finance companies want to avoid financial risk because finance companies, they make money on taking on financial risks. So for example, Lufthansa wants to buy these new Airbus planes. And Airbus tells them, we cannot deliver them to you today. It's not like a thing you get in a store and you buy it now. It does not work like that. They tell you, you get these planes in 2 years from now. And you know, Lufthansa is not stupid. They don't give them money until they receive the planes. They might give them part of the money, but majority of money is, you know, you give me the plane, I give you the money. This is how it works in real life. So they know in 2 years they will have to pay a bunch of money. And that's a lot of money, so they need a loan from a bank. So they go to a bank today and ask them, okay, could you give me a loan of 10 billion in 2 years from now for 10 years? Bank tells them, sure. But which rate are they going to charge them? Well, they are going to charge them a forward rate from year 2 till year 12. And you can calculate how much this rate is. And this is used a lot because, you know, companies like Lufthansa, they don't want to think about what is going to be the rate in 2 years from now. They are going to sign the contract today because they want to concentrate on building a good good aviation company. Then they don't want to make their money on betting on what's going to be the interest rate in 2 years from now. This is not their business. Banks do that. Investment banks do that. Lufthansa, this is not their business. Their business is flying planes and people and stuff. So this is why it's important, because wherever you work, it is very likely that you will need it. It is very likely that you will need it. It's even more likely that you will need it if you work in a Lufthansa than if you work in a bank. It's even more likely. Now, this thing that I'm talking about here is just one example of possible forward contracts. And these are these forward rates. In real life, this is so popular that you can buy, not only take loans today for things that happen in the future. You can actually go and buy 100,000 100,000 liters of fuel used to run planes in 5 years from now. You can buy that at the stock exchange. You can go to Chicago Mercantile Stock Exchange and buy whatever kind of forward contracts you want. This thing is being sold. I mean, there are people selling these kind of contracts. There are people selling contracts almost there. You can buy cows like this. But seriously, you can buy 100,000 cows and pigs in 2 years from now. There are contracts that allow you to do that. These are called forward contracts. You can buy whatever like that. But this is out of the scope of this class. We talk only about the forward rates. Now, the inflation. If you understand the example in the bottom left corner of this slide, you know everything about the inflation that you should know. And this example tells you, if the price of the apples today is $1, in a year from now it's $1.03, you have a 3% inflation, and you invest $100 today into something. After 1 year, you get $110. That means that in a sense, nominally, you have earned 10%. But in real stuff, how much more stuff you can buy 6.8% more stuff. You can buy 6.8% more apples. This is all you need. I mean, you can write down the formulas. And the first one you see, nominal R equal real R plus expected inflation. This is not correct. This is just the approximation. Actually, the real one is 1 plus real is equal 1 plus nominal over 1 plus inflation. But, I mean, you don't need formulas to do that. I mean, this is just the common sense. This thing in the bottom left corner is a common sense. If you understand this example, you know everything that you need to know about the inflation. So, when it comes to companies, you should understand first what is the return of a stock and what is the value of a company. There is a legend in apps that there was one really great student in this school, and he got an interview for the internship in some Goldman Sachs. And the guy interviewing him asked him the following question. If the price of the stock, of IBM stock, is $100 per stock, and let's say that there are 100 stocks of IBM out there, and book to market value of IBM is 0.3. What is the total value of the company? This guy was supposed to take number of stocks times the price of the stock. That would be 10,000. And that would be the answer to this question. But this guy gave him book to market value just to see whether he's easily distracted. And the guy did not know the answer. And I have given the similar example in the exam in last year or 2 years ago, I don't remember. And like 30% of people didn't know the answer. I mean, the point of exam is not to distract you. So I will try not to give you distracting questions and to see who is more confusable than the other. I mean, that's not the point of the exam. But at this basic level, like value of the company, I mean, you should not be confusable. This will kill you in any job interview. This will kill you. You will just be discarded. That's it. No matter how good you are. So try to think about it. I mean, value of the company. This is the basic thing. Number of stocks times price of the stock. That's it. That's the market capitalization. This is how much company is worth. If you had this amount of money, you could buy the whole company. It's as simple as that. Now, I just give these slides. Don't take these slides as, these are the list of formulas that you need for the exam. This is not the point of these slides. The point of these slides is that just to be the background of my talk. I mean, I have to put something there. I cannot just talk. So don't take them as this is the list of the formulas that you need. Don't print them out on this exam sheet and say this is the list of formula that I will need, and then there is some formula that you need which is not there, and then you tell me but you didn't have this formula in these slides. Well, I'm sorry. So you should know what's the value of the company, what's the return of the company, where does the price of the company comes from? Why is company worth anything? Because it gives you something in exchange. Then we said, okay, sometimes we can approximate the price of a company by some models. You can assume that companies perpetuous cash flow stream. Sometimes you can assume that the company is growing, like a growing perpetuity. And we said these all models are a bit simplified things, but they are not ridiculously simplified. And they are used in real life. This is something, if you try to appear at the court as an expert witness in court, this is how you will have to build your argument, using these kind of very simplistic models. I mean, I'm not inventing this. This is what people use in courts today to argue what's the value of the company. Why? I told you, there are more sophisticated models in finance. You can model stock price movement with some stochastic differential equation that stock price will go up and down, and it will really look like the movement of the stock, and you will be able to simulate it using some Monte Carlo simulations on your computers. And it's not that complicated, but the point is judge cannot understand that. Not because the judge is stupid. Judge is not stupid. These are usually smart people. But I mean, they're simply not trained to solve stochastic differential equations. So you have to convince them using simple formulas that they have learned in high school. Fractions, multiplications, additions, squares, but not stochastic differential equations. Now, every company in its life, sometimes or many times, is being faced with the following decision. Should I invest more into growth of my company, or should I just minimize the expenses and maximize the cash flow that I receive? Every company is facing this decision. And everything that I want you to know about this kind of decision is based in the example that was in one of these slides.
I have a question. Why did we take the 60%? Because the growth is just a 40% wall, because we just blow back 40% in the company, but we calculate the growth of
Zero.
minus.
So is your question regarding the growth rate,
No, the second.
the dividend that you get?
Why did we take the 5 and not the
So
3 point?
the whole dividend is 8.33. And you decide to plow back 40% of it. Plowing back means investing into company.
Yeah, so this will grow up.
So exactly, this will grow. 40% will grow at a rate of 25%, but you will pay out, you will distribute 60% of this to your investors.
Yeah, but we calculate the growth of 60% after.
No, the growth is here 40%. 40 times 25 is 0.1.
But why do we use the 5 instead of?
But this is the dividend. This is how much you pay to the guy that owns the stock. So this 5, you see, how do you calculate the price of a company? If there is a no growth, if I own this stock, what price I would be willing to pay? I would be willing to pay the price that is equal to the value of this perpetuity. And how much this company pays to me? To me as the stock owner, they will pay me 8.33 if there is no growth. If there is growth, they will, in the first period from now, give me 5. Why 5? Because the rest, 40%, they have invested into some projects. But they gave me 5 to me as a stockholder. They gave me a dividend of 5. Now, but we said usually in real life you wouldn't say company is already perpetuity, company is already growing annuity. Usually you would say you first model first part as some cash flow stream and then assume that this company will continue to grow forever at some reasonable, moderate growth rate, or even not grow at all. And I have given you this example. And nobody was confused with how do you calculate the present value of the first part of this cash flow stream, this thing circled there in red. Everybody knew how to do it. Nobody asked me any question regarding it. But regarding the second part, I received many questions. Why like that? Well, this is the problem of the timing and the formula for the growing perpetuity. C1 over R minus G means if I'm standing in year 6, this will look like my C1, okay? This will look like 1 year ahead, okay? Not from year 0. If I divide 1.59 with R minus G, this won't be the present value. This won't be the present value of this cash flow stream at 0. Why? Because C1 over R minus G means that the first payment is in a year from now. And this is in 7 years from now. So if I'm in year 6, then in year 6, I will be indifferent between this growing perpetuity thing circled in red and the cash flow stream received at year 6 equal to 1.59 divided by R minus G. And I put here C1. I could have put here C7, okay? It depends how you look at things. C1, C7, depends how you look at things. But you know, do you know how to calculate the present value of some cash flow stream in year 6? Yes, you know, because everybody had no problems with calculating cash flow stream in the previous slides. You just discount the thing in year 6 with 1 over 1 plus R to the power of 6. And how much do you receive in year 6? Well, in year 6, this cash flow is equivalent to C1 over R minus G. And it's simple as that. Any questions? And you add these two numbers together and you get the total present value of this thing. What? So, this slide is here not for you to learn it by heart or anything like that, or to print it in your cheat sheet that you will bring to the exam. This slide is here so I could tell you that actually the only thing I care about from this part are net present value and the internal rate of return. In the exam, I will not care about the book rate of return, payback, or profitability index. They are simply bad measures. You should know that. Okay, profitability index is maybe not that bad, but book rate and the other one are really bad measures. But I care about the net present value and internal rate of return. These things are I care about. So, this was the example of the internal rate of return. In this case, you could even calculate it by hand. If it had 3 cash flows, you could not. And in one of the exams, I have given like a cash flow stream with 4 or 5 payments and asked them, okay, what is the internal rate of return of this project? But I have given 3 possible answers. So, one, you don't need to be able to calculate it actually. You could have checked in this case if these 3 answers satisfy this equation. You just plug in answer number 1. Is it equal to 0? No. Answer number 2. Is it equal to 0? No. Answer number 3. Does it make equal to 0? Yes. This is the internal rate of return. And like half of the class could not do that. Don't allow things like that to yourself. Think. Now, you see, this text says something like this. You can purchase a turbo power machine tool for 4,000. The investment will generate 2,000 and 4,000 for 2 years respectively. What is the internal rate of return of this investment? Now, let's just rephrase this text in a different way. Let's say the following. The bond price that you buy today for $4,000, this is the market price. This is what you have to pay for this bond. Will give you 2,000 in year 1 and 4,000 in year 2. Now, try to think about it, why yield to maturity of the bond is the same thing as internal rate of return of a bond. You see, if you put this market price to the right-hand side, you will get internal rate of return of a bond is what makes bond's present value equal to its price. It's the same thing as saying it's what makes the cash flow stream of a bond net present value equal to 0 if you bought a bond for the market price, okay? I hope now you understand the connection between the yield to maturity and internal rate of return, and why and how in the homework we have been using the internal rate of return function in Excel to calculate actually the net present value, how to calculate the yield to maturity of a bond. Okay? Now, what you should be careful about in general is internal rate of returns is sometimes tricky to interpret and do. There are these pitfalls that I have given you. Some of them are less important, some of them are more important. Undefined internal rate of return is less important because internal rate of return cannot be calculated only for a strictly positive or a strictly negative cash flow stream. Therefore, you don't care because you don't like the strictly negative and you don't like and you love strictly positive. So you don't need a decision tool of any kind. You don't need the net present value. You don't need the internal rate of return. It's good. But however, there are other pitfalls that are difficult to solve. And they are super, super important. Why? Because there is a 76% chance that your boss, whatever you do, will ask you about the internal rate of return. And now, imagine that this project, this cash flow stream, or this this project cash flow stream, whatever, has a multiple internal rates of returns. And we know that the number of internal rate of returns that you can calculate depends on the number of switches from negative to positive. As many these switches there are, as many solutions will be. And now imagine he asks you what is the internal rate of return of this project, and you tell him, well, it's 11%. But what if it turns out that in reality it's minus 40%? You get fired. It's as simple as that. Nobody will keep you in your job if you tell your boss, yeah, you should invest because it gives you 10%, but in reality it's losing 40% of money. I mean, these are the things for which you lose the job. And this is why you should be aware of these pitfalls, because there is a high probability that they will ask you about the internal rate of return, and interpreting it is not as simple as the net present value. It's good measure, but it has its problems. The equivalent annual costs. Stick to the way how I described it in the slides and not how it's done in the book. In the book, it's done in, I think, a bit wrong and confusing way. And in all books, it's done like that. I believe it should be done like I did it in my slides. And I have given you a good example how to do it. And why is that important? Because these are the questions that every firm is asking. This is not just should I buy a cheaper machine or the more expensive machine. This is like, should I buy a cheaper car or more expensive car? The more expensive car will last longer, but the cheaper car is cheaper. Which one should I buy? This is also the question that Lufthansa is asking. Should I buy the expensive Airbus and Boeing planes, or should I buy cheap Brazilian Bombardier planes? It's the relevant question, and it's not just, yeah, I will buy the more expensive ones. Why? You have to understand equivalent annual cost because of that. Now, everything that I have told you so far has to do with interest rate calculus and with the net present value. You know, this is the knowledge that was required for a person graduating in their 8th grade of elementary school in the US in the 1895. So 14-year-old kids were able to answer many of these questions that I have talked about so far. Not all, but many. And you should be able to do that as well. Now, the things that we are going to talk about now, the relationship between the risk and the return, are a bit different. They are kind of new. CAPM, Nobel Prize, this thing was invented in the 70s. It was not existing in 1895. So, what did we say? We started with this quiz, and we said, everybody prefers getting 5 million for sure than gambling and getting 10 millions for sure compared to 0 million, to losing everything with probability 1/2. So 5 millions for sure is preferred toward 10 million with probability 1/2 and losing everything with probability 1/2. Now if you push this extreme example to something more, that you don't have only these extreme cases, losing everything, winning everything, into stocks, you get this kind of distribution in which you can see how often, in which years in our history, if you were investing into all US stocks, you would lose 50%, you would win 60, you would win 10, you would win 20, etc. And you get to this kind of distribution. And then we said, because we don't like risk, this width of this distribution will tell us how this thing is risky. And then we said, okay, if you plot these same numbers, the same numbers on this chart, if you just plot them over time to see, okay, in 1931 you lost between 50 and 40%. You can observe that on this chart as well. This is the green line. These are for stocks. You can see that in 1931 you lost around 45%. Now, if you observe this chart, you can see stocks are moving up and down like crazy, while bonds are a little bit more moderate. And these stocks, this means that you have invested into value-weighted market portfolio, actually. Now, but why would then anybody hold stocks? Because they are riskier. Well, because they offer more in return. If you invested $1 in 1926, you would earn much more from stocks than in bonds up to now. And note, empirically proven fact is that one of the main differences between the poor and the rich people in the US is that the rich people invest into bonds and stocks, while poor people don't do that even when they have money to do so. So even when they can afford to invest some of their money into bonds and stocks, they don't do that, while the rich people do that. This is one of the main differences between the rich and the poor. And this is for the reason. Now, this percentage that you earn more by investing into stocks compared to bonds, it's called the risk premium, market risk premium. And actually, how do you measure riskiness of a single stock? We know what's a return of a stock. How do you measure riskiness of a single stock? You calculate the standard deviation of a stock. And as I said, I don't care whether you learn that by heart or you have something in a cheat sheet to help you calculate it. But it's pretty simple. You calculate the mean of the return, you calculate the deviation from each observation from its mean, you put these numbers to the square, and these are square deviation. And now average number among these is the variance, and square root of it is standard deviation. It's as simple as that. Now, but we know that people often invest into portfolios and not in a single stock. And actually rich people invest into more stocks than poor people. And this is with the reason, because they know how to invest. You never invest into one single stock. And portfolio return is just the weighted average. You should be able to calculate the return of a portfolio. This is a must know. you should also be able to calculate the risk of a portfolio. In the exam, I will not ask you calculate me the risk of a portfolio of 10 stocks, because that would imply that you construct a table of 10 by 10 size and calculate 100 elements in this table, add them together, and take the square root of this sum. I will not ask you to do that, but you can calculate a risk of portfolio of, let's say, 3 stocks. It's just 3 by 3 table. There are only 9 elements that you have to add up. Or in the case of 2 stocks, you have to add 4 numbers. How difficult is that? And there is a clear logic how you fill in the number in this table. If you have done it only once, if you have solved a single exercise with these things, you will be able to do it even without having it in a cheat sheet, because it's really easy. There is a clear logic how you fill in these numbers. It's not, complicated logic that you have to calculate what to. It's a clear logic how you do it. And you should know how to do that. Now what we have said is that as you increase numbers in your number of stocks in which you invest, the risk of your portfolio investment is approaching the market risk, and all the unique risk goes away. Unique risk goes to 0. What's the point of this? This tells you you should never invest in a single stock. You should invest in at least 15 or 20 stocks. This way, by doing that, you are getting rid of all easily diversifiable risk. The fact whether some CEO is crazy or not is not related to the performance of market. You get rid of the risk of having a crazy CEO. Everybody wants to get rid of this risk. Why not? And it costs you nothing. It costs you nothing to invest into 10 compared to 1 company. It's a costless process. But then we said, okay, if all of us know this, if all of us know that you can easily get rid of this company-specific risk, then all of us will invest our money into some portfolios. Then when I observe some and I consider some other stock, whether I should add it to my portfolio or not, then the standard deviation of this stock is not really a measure of the riskiness of this stock for me. The measure of the riskiness will be how much this stock will change the riskiness of what I have. So imagine you have something, you have invested into 20 stocks, and this is very much correlated with the market. As we have seen, this approaches market risk very fast. So it moves almost like a market moves. So if I hold a portfolio which moves like the market portfolio, then the measure of riskiness of some stock will be actually beta. Why? Well, imagine that you hold this portfolio. Now you say, I will invest half of my money into this portfolio which moves like market, and half of my money into, let's say, some stock that has beta higher than 1. Then what will happen with the risk of my portfolio? Half of my money will move like a market, half of my money, since beta is larger, will move even more down when the market goes down. So let's say market moves down, and this is half of my money. And then half of my money goes down even more, because it has beta higher than 1, this company. So on average, I will move something in between these two things. When market moves up, this company will move up even more. So I will move something in between, okay? So this tells you that companies with beta higher than 1 will actually increase your risk. But if you add companies with beta smaller than 1, what does beta smaller than 1 mean? When market moves down, this company moves down but a little bit, or it can even move up if beta is negative. Now, if market moves up, that means that this company moves down less or even moves in a different direction. That means that on average, my money will move something in between these two movements. So this will reduce my risk. And this is why we say that the beta actually measures the risk of a company. Beta measures the risk of a company if conditional that you are well diversified, that you hold a portfolio that is approximately having the market risk. Now, if you're holding only this company, then the measure for you is in standard deviation, but this is a bad strategy. I consider that you know enough that you will never invest in one single company. And the beta is easy to calculate. You don't need a fancy statistical software to do it. You can do it by yourself. You just calculate the variance of the market and you calculate the covariance of these stock returns with the market. And I have given you a recipe in this table. It's straightforward. You divide these two numbers and you get beta, or let's say in this case 1.5. Now, we said the following. If you can invest in stocks only, if stocks are only investment that you can make, then there are some combination of stocks that are better than the other. And the best ones are on this efficient frontier. So for different levels of risk, you will be able to get the best return that you can achieve. And we have showed in the class how do we get to the shape and how does it look. We started by combining two stocks, X-shaped curve, then portfolio of two stocks with the third stock. We again get, and we move to the top left, and you would get to something like the efficient frontier. However, if you are allowed to invest into bonds as well, not only stocks, it turns out that among the stock combinations, there is one portfolio that is by far the best. Out of all these efficient portfolios, there is one that is by far the best. And we said this is the value-weighted market portfolio. And for this reason, you should know how to calculate weights in this portfolio. You should know that how to calculate the weights in the value-weighted portfolio. Why? Because this is the best thing in the world that you can do. You cannot do better than that. This is what theory tells you. And this is why you should know it. Because after this class, I don't want you to go and invest your money into Microsoft stock. This is stupid. You should diversify your risk. You should invest in many stocks and you should invest money. Here we show that the best way, at least theory predicts that the best way is the value-weighted portfolio. Okay, ideally value-weighted market portfolio would be that you invest in all companies proportion that is kind of proportional to the value of this company compared to the value of the whole market. However, you cannot invest in all companies because you don't have enough money. But you can easily invest into 30 companies. And if you are investing in 3 companies, this is how you do it. If you are investing in 30 companies, it's still very easy to do. It's just the proportion of the value of this of one company compared to the values of all other companies together, of all companies together, including this one. Okay? This is then how you do it. And we said, by mixing this value-weighted market portfolio and bonds, you can achieve the best risk-return combination out of all combinations. So you don't invest into some combination of stocks, you invest in the value-weighted market and you combine it with bonds depending on how much risk you want. Or you can even borrow at the risk-free rate and increase your risk and get higher return. And we said, this is the Nobel Prize. This is the Nobel Prize. It tells you every stock has to earn this amount of money. Every stock has to earn this amount of money. And you already know how to calculate this equation. So return of a stock is equal to risk-free. Where can you get the risk-free rate? It's easy. You go to the website of the Treasury Department. You have different rates. You have bond returns there. Return on the market, this can be return on the market, this can be return on, if you are a US investor, this can be a return on the Standard & Poor Composite Index. If you are mainly investing in Germany, this can be a DAX index. But you can download these returns from internet. They exist. It's easy to find them. So everything on the right-hand side, only thing that you need to calculate is beta. And you know how to calculate beta. Therefore, you know how to calculate the return of every stock in the world. But this return tells you one important thing. It's a future-looking device. It's a fortune teller. It's a fortune teller because of the following fact. Return today depends on the price today and on the price in the future. That means that you can actually calculate what is the future price of a stock. You can say what everybody in the market expects that the future price of the stock is going to be. It's a fortune-telling device. It tells you the future, this equation. And this is by far, if you ask me, the most important equation in finance. This is the most important Nobel Prize in economics, if you ask me. It has completely changed the finance as we know it. You know, before this, finance was blah blah. This is not a joke. You should read papers before 70s. I mean, they were blah blah papers. You could not say anything. You could not say, okay, is this stock A better than stock B? Yeah, it's better because I think it has a better CEO, whatever. Come on. It was just some blah blah. You could not relate risk and return. We didn't know any relationship between the risk and return before 1970s. It has completely changed finance from, I would say, a social science like marketing, management, and other things, to a quantitative science. From the 70s on, finance has become quantitative science, where you can say, this is better than this, and not, I think that this might be better than this, as people in non-quantitative sciences usually frame their answers. I mean, I don't want to say bad things about other sciences. I mean, some sciences are younger than others, some are evolved more than the others. Physics is much more mature than the finance will probably ever be. But this has changed the world of finance as we know it. This is the most important Nobel Prize in economics, if you ask me. And you have learned it. And I believe that most of you understand this equation. And it's not that difficult to understand, actually. Now, some of this stuff I will talk about is maybe not the most important for the example, but I have never revised this last class. So I will now a little bit revise this last class. Some things are more, some things are less. So far, everything was very important for the exam. Now, more or less. Some things are important, some things are less important, but some things are still important for the exam. So one thing we said is that, you know, in this CAPM world, it's very nice, however, it has some problems. These betas change over time. So what does beta of a company today means? Because it was different yesterday, 2 days ago, 3 days ago. How do you estimate what's a beta today? And we said there are two ways how to deal with these problems. Observe not so distant past when you are estimating beta. The closest thing that you can get is the best. And try to estimate betas of industry portfolios. These betas are much more stable over time, and you estimate them with smaller error. Estimation error is smaller for portfolio betas than for company-specific betas. So Burlington Northern is some railway company, and this railway company's beta will change a lot over time, and we will not be that good in estimating it. Our estimation error will be kind of not so small. But if you observe portfolio of all railway companies, this beta will be more stable over time, and in addition, we will have a lower estimation error. Now, what does this thing implies? CAPM equation. CAPM equation implies one important fact, that the return of your investment into company, return that company gives you, depends only on one firm characteristic, which is beta. You see, everything else in the right-hand side of this equation, this is return on the bonds, this is return on the market. This is not company specific. This is not characteristic of a company, while beta is specific to this company. Every company will have a different beta, while all companies will have, I mean, bond returns are not even a property of a company. And this implies that if you sort companies according to high beta and low beta. High beta companies will give you high returns, low beta companies will give you low returns. But if you sort companies according to size, small companies versus big companies, they should give you the same thing, because this is not beta. Only thing that matters for the return is beta. However, it turns out, this was almost 40 years ago, this CAPM equation. And then some smart guys, Fama and French, they figured out that actually some other firm characteristics matter. So if you sort companies according to size, it will turn out that on average, small companies will give you higher returns than large companies. And if you calculate this difference, return of small minus return of big, this should be 0, okay? But if you invest, let's say, $1 into such strategy that will be return of small minus return of big, on average it will grow. The same goes for high to low book to market high and low book to market value companies. And this should not matter. The only thing that should matter is actually the beta. Small beta versus high beta should give you small versus high returns. All other firm characteristics should not matter. And there is a fourth characteristic that matters, which is called the momentum, which is, if you observe performance of companies over last year, the good performing companies, let's call them winners from the last year, will continue being winners in the following year. Losers in the last year will continue being losers in the following year. So in a sense, if you invest money into last year winners and last year losers, on average, they will not give you the same. Winners will give you more, okay? And this should not be. Only high beta versus low beta should be. And this leads us to what is called the Fama-French four-factor model. Now, don't get terrified with this equation. This is the same thing as the CAPM, it just has more factors. To try to explain you how it works, I will use the following example. Let's pretend that we don't have this Fama-French 3 and Fama-French 4 factor. Let's say that we have only two factor model, Fama-French 2 and CAPM, and this beta. So, if you see me standing now in this corner of the room, imagine that this corner going like this is one axis, and this axis measures return on the market. This other measures return on the small minus big companies, okay? Return of small minus return of big. And this measures return of the value-weighted market portfolio. Now, on on this vertical axis, this is the return of any company. If this is the return of a company described by this equation, which now has only two factors, then we won't have anymore just a straight line. We will have like a plane going through this space. Okay, it will be some plane like this piece of paper, which will tell you for any combination of return of small minus big and market, what is the return that you observe in your company, okay? So you would fit like this plane. So first beta, normal beta that we call it, will be the slope of this plane with respect to this axis. The second beta would be slope of this plane, actually second beta I call Fama-French factor 2, would be the slope of this axis with respect the slope of returns of company with the respect to the return of small minus big companies. It's the same thing as the CAPM. You just have more dimensions. It's not only that the return of market is important, but also important is the return of small minus big companies. Important is return of high minus low companies, and important is this momentum factor. And we said, you download these historical values. What was the return of small minus big companies 2 months ago, 3 months ago, 4 months ago? You download this from the website of Kenneth French. You download excess market returns from his website. You download high minus low returns from his website. You download momentum from his website. You download all this from his website. So the only thing that you need is basically the excess return of a company. And you know why is this important? This is maybe not important if you're gonna work in Lufthansa, okay? But this is super important if you're gonna work in any investment fund or investment bank or in pension funds. This is your benchmark now. Your benchmark in 2011 is not CAPM. It's four-factor Fama-French model. And you know what is your benchmark? Imagine on this CAPM chart, what did we say? You won't invest in companies that are below the security market line because they offer you less return given risk. Now, this equation tells you, okay, you don't have this line, you have more dimensions, but doesn't matter. You won't invest into firms that are below this hyperplane, let's call it. But imagine you are a fund manager in Deutsche Bank. They will never give you a job if you are not able to beat the performance of the market portfolio in, say, APM world. Why would they pay to some fund manager salary to replicate the value-weighted portfolio? You have to be better than that. But in reality, you actually have to be better than this. And how do you test whether you are better than this? Actually, the test is very simple. The test is very simple. If you know in statistics, if you have learned, any line can be described as alpha plus beta times x, or a plus bx. This is the equation of every line. Now, in this world, we don't have just a simple line anymore. We have more axes. There is not only one axis. There are more axes. But you still estimate alpha intercept plus different betas. Beta of this beta, Fama-French 2, Fama-French 3, Fama-French 4 factor. And any statistical software can do it, even Excel can do it really easily. It's one line command. And now, if you rewrite this equation in the following form, that you put this risk-free rate on the left-hand side, usually you write return is equal to risk-free plus something, but put it on the left-hand side, then this equation predicts that there should be no intercept. This line should intercept at 0. It should cross through 0, okay? This is like, imagine you're writing a CAPM equation as return minus risk-free is equal to beta times return on the market minus risk-free. If you write it down like that, there is no intercept. So your statistical test is, okay, is this fund manager, does he has alpha? Is he able to generate intercept? If you are generating alpha, that means that you are good. If your alpha is positive, that means that you are systematically beating what theory predicts. And this is very easy to test. You will see it in some other classes. It's very easy to test whether your alpha is significantly different than 0 or not. And this is what when you hear about investment funds, when they talk about this fund generates great alpha, alpha is bad, alpha is this. This is what they are talking about. They are talking about the alpha in the multi-factor model. They are talking about the intercept in this model. Okay, let me stop here. I started talking too much. So, you can also diversify your money internationally. And then for you, the important thing is beta of your domestic market with or beta of these markets with your domestic market. So if your domestic market is the US, if you're holding the US market portfolio, it doesn't mean where you are born or where you are living. It means where the most of your money is invested. If you are invested in the US companies, then this would be your beta with different countries. So that would mean by investing in Turkey, you would amplify your risk, but you would get more in return. If you invest in China, you will actually decrease your risk, etc., etc. For Germany, you would have to calculate this by yourself. Now, how does this all risk-return relationship, what are the implications of the whole Nobel Prize story with the valuing of projects? Implications are important. And even many of my colleagues do not understand them. So I have heard many of my colleagues saying things like, riskiness of the project is like, what's the probability that this project is completed? This is not the riskiness of the project. Because everything that is diversifiable is not the riskiness of the project. Whether a CEO is crazy or not is not the riskiness of the project. If I invest in 100 companies, this does not influence my risk at all. What influences my risk is how this project moves together with the market, this cyclicality thing. So more risky projects are those that are more moving with the market, like projects involving airlines, luxury, tourism, restaurants, because these are the things on which people save when market does badly, and these are the people on which people spend money when markets go well. Okay? Now, on the other hand, there are some less risky projects like food, tobacco, baby products, etc. Why? Because these are the things that are not related to the recessions. They are not related to the booms. Babies consume same amount of diapers no matter whether there is a crisis or not. Baby will not stop pooing less because it's an economic crisis currently. They don't care about these things. So don't get fooled by the diversifiable risks. They are not the measure of riskiness of the project. This you can easily diversify. And please make life tough on my colleagues that try to argue differently. And some will for sure. I have no doubts about that. Now, another important thing, and the last thing that I will tell you is that don't confuse riskiness of the project with the beta of the project that is investing into it. So whether Microsoft is doing the thing, or IBM is doing the project, or Apple is doing the project, has nothing to do with the riskiness of the project. The measure of riskiness of the project is the beta of the project itself. It's unrelated to the beta of the company that is investing into this project. This is a common mistake that people do in real life. So let me talk about the exam now. First thing, you can bring one A4 sheet printed on handwritten on both sides. And you can print it on computer or you can write it down with pencil or whatever, it's your choice. You will have to submit this sheet together with the exam. So at the end, this sheet will be collected. I will tell you why a bit later. I have crossed this. You can write on this sheet only stuff relevant for my exam. You can write on it whatever you want. I don't care. You can write poems if you want. I don't care. The point is that I have wrote this at the beginning because I was fighting with the examination office to split your exam from the statistic exam. Because statistic professor does not allow you to bring anything, and I do. And in decision theory, Petra also allows you to bring whatever. Now, the point is, now the exam is going to be first statistics, then these exams are going to be collected, and then you will be able to use your sheet. You won't be able to use this sheet in the statistics part, okay? It took a lot of fight with them, but they finally accepted this thing, that the exams are split. You can use it for the decision theory. So the decision theory part and this part in together will be 1.5 hours. And you can divide your time as how you would like it. Now, I really don't understand why did they even connected these two things. I mean, these exams are unrelated and it's like 3 hours. I mean, I know from these classes that your concentration is 56 to 58 minutes. After that, you're in the and 3 hours exam. And I tell them, and they tell me, yeah, but you know, in Germany, this is a common thing that exams are long. So, does it mean that this is good? I mean, I simply do not understand. It's like the point of exam is to be tough. No, it's not. The point of exam is to measure whether he knows more than he does. It's not to be tough. So, you will have a separate. Then I was actually making jokes, like, you know, and make sure that in between these two exams, they have to do 100 push-ups. Who does not do that, don't let them Don't let them pass. I have also tried to fight them in the thing with the official calculator, but simply they don't accept it. I told them they can use whatever calculator they want. They tell me, no, they have to use the official calculator. I tell them, but do you understand, when these people come to their work, it's not that the first thing their boss does is, here's the official calculator that you can use. I mean, this is simply how things do not work in real life. But they don't want to accept it. I cannot fight them. I tried, so you have to use these official calculators. I mean, I'm sorry. So, I will construct my exam like that at least some of you are able to solve it in 60 minutes. So, 60. So, 60 minutes, 60. Some of you should be able to do it, some of you shouldn't. That's the point of the exam. Now, next to there will be many small problems, so you could diversify. But next to each question, you will have the number of points written in bold letters. This will serve you as a guidance. If it says 3 points, that means I assume that you should be able to solve this problem in 3 minutes. If you think that you are not able to do it, move down and do it, and if you think you need 10 minutes and not 4 minutes, then move to the next question. And you solve it if you have time. Time management is important thing during the exam. And these points should serve you as a guidance how to do stuff. How would I prepare the exam if I were in your shoes? First, I would try to understand the slides and everything I have said in these lectures, and you have the video lectures to help you there. I would prepare this cheat sheet by myself. And this is why I want you to submit it to me, so I could do statistics later. And I have done the following statistics. I have compared the results of people that have used somebody else's cheat sheet copy and those that have constructed their own. People that construct their own cheat sheets do much better. You need time to do it. It requires effort, but do it yourself. You will know what is written where, and you will know what you have written. Don't rely on other people. Yeah, he knows better, he will construct a better sheet. That's not the point. The point of allowing you to have a sheet is, first, you are forced to learn during this process. You cannot do it just like write some random stuff. You have to learn to do it properly. So you need to dedicate some time to this exam in learning and doing it. Second, I mean, when you're doing it, you know where you write what. And people usually use either very small font if they print it on a computer, or write in tiny letters. And you will never be able to figure out what other people have done. So try to do it yourself. I would try to understand the homework. And you know, the homework is tougher than the exam. But this is by intention. This is not coincidence. If I give you tough homework as I have given you, you will try 1 hour to solve it. You won't succeed. Then you will try next day 1 hour. You won't succeed. Then I will send you the solutions. Then after 1 hour, you will be able to solve it. And you have spent 3 hours working on this homework. If I give you just some easy random exercises, you will be done in 15 minutes and that's it. You will spend 0 time working on it. This was the point of the tough homework. Exam will not be like that. The point of exam is not to force you to study. This is a bit too late if you are doing it at the exam. You should do that before the exam. The point of the exam is to compare you among each other. I will upload the exam from the previous or 2 years ago. I don't know for which one I have the solutions. I will upload the one for which I have solved it nicely and I have the solutions. So you'll get this exam with the solution. Solve it. It won't be the same as this year, of course, for obvious reason. But the other reason is that I have done different stuff in previous years compared to this year. So it will be related to the stuff that we have done. There will be more emphasis. I will more emphasize stuff that we have done more. It was different in different years. So don't use this exam as a guidance to how exactly your exam will look like. This is just a model of exam to get the feeling how these exercises look like. And then I would try to solve the problems from the book. There are many good problems in the book, and I have uploaded the solutions for all the problems in the book. You have it in CampusNet. And then at the end, I would read the book. So exercises in the exam. People, could you just 2 more minutes? Try, so the problems that you are going to be asked to solve is B. Calculate this, calculate that. Should I invest in A? Should I invest in B? Should I do this or that? It won't be give me a definition of whatever. You won't have any question like this. So what I have given you so far are slides in different formats. You have video lectures, you have book, you have lecture notes, you have homework and solutions. And what I will give you more is more homework with solutions. I will give you a mock-up exam, this kind of a model exam with the solutions. I will still answer your emails, even though this is our last class. But I will not answer them 2 days before the exam. Because 2 days before the exam, people somehow start panicking, and then I receive hundreds of emails per day. I simply cannot answer these hundreds of emails 2 days before the exam. And I offer you office hours. I was not able to do this during the lectures because I was teaching Monday, Tuesday, Thursday, Friday this class in 5 different groups, and I was teaching on Wednesday derivatives class in the master. So there was simply no time. I had to prepare lectures over the weekend and stuff, so I couldn't offer you office hours. But now, this is my last class. I will be in my office in Wiesbaden. If you have doubts, if this is not solvable by email, send me an email. I will schedule you a meeting in a group or person by person, does not matter. So